People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
I'm Jon Heischman, your host of the Safe Money and Retirement Show that you've tuned into. And thank you for listening. Every week I want to give you ideas and bring to you strategies that will provide you with a better retirement. Today's show, I'm going to address asset allocation. So what is asset allocation? It's allocating available funds among a number of asset classes in a way that meets the needs of a particular client, dampens the effect of periodic market fluctuation, plus it meets investment goals. Asset allocation is based upon the fact that different broad categories of investments have, over time, exhibited varying rates of return and different levels of price volatility, in addition to exhibiting that volatility at different times. Okay, you're thinking, Jon, you gave me the definition, but how does that apply to my retirement plan? When I talk about asset allocation, I'm not referring to your Social Security income or your pension income. I'm referring to the accounts that are under managed money, typically money at risk that needs to be allocated in different strategies. The big thing about asset allocation is that money from these accounts will more than likely be used for income in the future. I've already mentioned you don't have to worry about Social Security. There's nothing to allocate there. If you have a pension, there's nothing to allocate with a pension. It is what it is. It's going to come in every month. It's guaranteed, and you can count on that income being there. For most people, those two sources of income are not enough to meet the retirees' income needs. So we can draw from a managed account, such as a brokerage account, where there are multiple components and, again, typically at risk. A very important aspect of asset allocation is knowing the time frames for the retirees' financial goals and future income. Let me give you an example. If an investor is in retirement and needs to fund their retirement for the first 3 to 5 years, that goal would require an asset that will fluctuate a little bit, if at all, in price to ensure meeting that goal. On the other hand, let's say a 25-year-old who is investing for retirement could invest in both, let's say, stocks and bonds, because there is plenty of time to ride out the volatility of those stocks. So the asset allocation of a specific retiree needs to be tailored to that retiree's goals. People are so different in their goals and objectives, which is a reason to understand that asset allocations suggest general guidelines that may or may not be appropriate for that individual. Putting together a retirement plan, my son and I, who are the principals of Heischman Financial Services, look at each client's portfolio based on their goals and objectives, plus taking into consideration other income sources such as Social Security and pensions. And maybe there is a retirement account, let's say it's an IRA, that includes the guaranteed lifetime income benefit, which is another source of income that's reliable, dependable, and it's going to be there for the rest of your life. That being the case, we may not need to use all of the money from the accounts that are involved in asset allocation for income. And that being the case, those funds can continue to grow in order to get the maximum returns. Then possibly later in retirement, to offset inflation, taxes, and healthcare costs, we can set it up to draw additional income. Let's say you've just retired and you're not sure that you're allocated correctly based on your goals and objectives, based on your risk tolerance. It really needs to be addressed. So we can look at the allocations that you currently have, review your situation, and help to make any asset allocation changes. And here's a good example that might apply is a retiree does not have pensions, but has Social Security that is not going to meet their monthly income needs. Therefore, the asset allocation is more important because they're going to need more income from those accounts compared to the retiree that has Social Security, maybe a pension, maybe two pensions, and as mentioned earlier, other sources of guaranteed income. So that asset allocation to the latter retiree, it's important, but not as critical, you might say, as that individual that's going to be dependent on money under management for income. And we all know everybody is different. Their savings, their retirement accounts are different. And there are so many scenarios, options today that can help each individual's goals and objectives. But of course, as always, we have to first look at where you are. I'm going to give you the number to call with questions, with your concerns about asset allocation and how it applies to your accounts. 888-426-0177. It's so important to address early in retirement. Make some minor adjustments or some big changes. 888-426-0177. And I think it's very important that even if a large part of a retiree's portfolio is correctly allocated, we still have to address a severe bear market can scare that investor into selling at a bad time. The correct time is to have the portfolio properly allocated for that client is before not after, the market goes down. Many individuals overestimate the amount of risk they're comfortable with, especially if the market has been rising for a few years. We've experienced this fear, which was confirmed during the 2000 to 2002 and October of 2007 to March 2009 periods. Retirement planning has to take these situations into consideration. Now, hopefully those periods of times will never happen again, but you have to be prepared and correctly allocated so you don't lose 20, 30, or 40% of your money that's going to be used for retirement income. We have to look at retirement income as a lifetime plan covering all risk, all situations, making sure your plan is still going to be secure with income in the event those times reoccur. After the break, I'm going to continue my discussion on asset allocation, and I want to give you the number to be able to give us a call, talk about your situation, address it now before it's too late. 888-426-0177, 888-426-0177. And don't forget to visit our website, which is HeischmanFS.com. HeischmanFS.com. Stay tuned. I'll be right back.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
The goals of good retirement planning are to help each individual to end up with more money at the end of the day, but also provide more income during retirement. And this creates a less stressful investment experience, especially in times like this. I like to emphasize and stress stronger financial understanding. Not only could you have greater wealth, more income, and a better night's sleep, you should also have a stronger grasp of your own financial standing. With a strong retirement plan in place, you're going to know exactly what you can withdraw from your retirement accounts every month, how much you need to live comfortably, and how long your savings is going to last. This is Jon Heischman, your host with the Safe Money and Retirement Show, 888-426-0177, 888-426-0177.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
I'm back bringing you the second part of the Safe Money and Retirement Show. I'm your host, Jon Heischman. I was discussing asset allocation, and a very big part of that is to address and try and prevent what we call sequence of return risk. During the accumulation phase, and this is the phase where you're contributing to a 401k plan and or IRA, the order of returns is not really an overriding concern. For example, an investor who is not adding to a position has the same return if the portfolio went up 20% in the first year and then down 20% in the second year. Or if the portfolio went down 20% in the first year and then up 20% in the second year. Now, either one of these examples, let's say the investor who starts with a $1,000 account ends up with $960. Therefore, the order of returns in a somewhat secondary matter when accumulating shares. But the situation is quite different for retired investments and those rapidly approaching retirement. When your portfolio has withdrawals, and typically these withdrawals are going to be for income, the sequence of return is critical. Why? Because your withdrawals of a fixed amount during investment downturns is going to require more shares to produce the same withdrawal amount. It's referred to as negative dollar cost averaging. And I can give you an example where at $10 a share, it takes only 10 shares to produce a $100 withdrawal. If shares drop by 50% to $5 a share, it takes 20 shares for the retiree to receive the same $100. Now, the problem is that now the extra 10 shares are gone and would not participate in the investor's eventual recovery. I think the worst case scenario is large sustained losses early in retirement. Therefore, retirees must manage sequence of return risk in ways that may never have even been considered during the accumulation phase. We don't have to worry about sequence of return risk during that accumulation phase because, again, the investor could be 25 years old, 35, 45, and has plenty of time to make up those losses. Time is on the young investor's saver side, but in retirement, that time horizon has shortened. And my point is, we really need to address the potential for sequence of return risk at retirement as soon as possible. One way to manage this sequence of returns risk is to invest a larger percentage of your portfolio asset allocation in lower volatility assets. Here, we've reduced the risk and the possibility of sequence of returns risk. Another way, I refer to it as the bucket approach, where withdrawals come only from a conservative portion of the total portfolio, and the rest of the portfolio is invested for those higher returns. Here's an example with a 3-year bucket approach. This is money in this bucket. The short-term bucket starts with 3 years of withdrawals for income. Then withdrawals are taken only from that short-term bucket. Again, low volatility investments. Over time, the short-term bucket is replaced from the long-term bucket. In this scenario, if the market experiences a large downturn, the withdrawals from the short-term bucket allow time for the rest of the portfolio that's going to provide retirement income to recover. The larger the short-term bucket, the more it defends against a market downturn and the sequence of withdrawal risk. However, fewer assets in the long-term bucket may mean the overall portfolio doesn't have enough return for the portfolio to last over the long term. I don't mean to be confusing, and I'm sure a lot of you are just not sure how sequence of returns risk works. But the bottom line, if it does happen in early retirement, with the money that you're going to use for retirement income may or may not be recovered. Because back to my example earlier, let's say 1 to 2 years, you have lost 20% in value, but in the future years, you make 20%. You have not replaced that 20% loss. Multiple years in that scenario could have a huge effect on your future retirement income. Many of you have not heard of the term sequence of risk returns. Unfortunately, it's not brought to the retiree's attention like I think it should be. If you have money at risk and you're not dependent on that money for retirement income, you don't have to be as concerned. Very simply, you're not dependent on that income or as much that it could generate later in retirement. Take some time. Think about where is your money? And I'm referring to the money that is going to be used for income. Could it be exposed to sequence of returns risk? And if it is, we need to address asset allocations. I can help you to determine if you're in that situation, help with adjustments, or reposition funds so you don't have to worry about that problem occurring in the future. And believe me, it is a big problem. It's a surprise. And many say, I was never told about this, or sequence of returns risk was never addressed. And I want to make sure 10 years in retirement, you don't have an income problem. 888-426-0177 is your number to contact me to address where you're at, what and how much you're exposed to, and get some ideas on how to correct that as soon as possible. Drawing down the same amount of income during multiple down market years could have a devastating effect on your retirement income. And as you hear me say on my shows, if each retiree could structure their retirement plan with sources of guaranteed income, we wouldn't have to be so concerned about sequence of returns risk. And one of the best times to discuss those options for guaranteed lifetime income is when you're rolling over a 401k plan, for example. What are your options for the rollover? And address asset allocations to help prevent sequence of returns risk. And that's what we do in retirement planning. I want to thank you for joining me today. This show has been about safe money, and that's why the show is called the Safe Money and Retirement Show. Let me give you the number one more time, 888-426-0177, 888-426-0177. Enjoy your week. I'll be back next week at the same time, the same station, for another version of the Safe Money and Retirement Show.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.